All right, everyone, let's settle in. Look, if you're planning on going into business, and I mean in any capacity, as a founder, a manager, an investor, whatever, there is a single concept that if you don't master it can lead to absolute disaster. But if you do get it, it gives you a kind of X-ray vision into the health of a company. So today, we're going to do a real deep dive into that very idea, the power of accrual accounting. Let's get started. So here's our game plan. First, we're going to talk about something I call the illusion of cash. Then we'll get into the nitty-gritty of accrual versus cash accounting. After that, we'll unpack the beautiful logic of what's called the matching principle. Then, and this is the fun part, we'll apply all of it to a real-world scenario to see how it works in practice. And finally, we'll talk about why this one concept will give you a serious edge in your career. Okay, Section 1, the illusion of cash. Now, this just sounds wrong, doesn't it? I mean, if your company's bank account is full of cash, that has to be a good thing. It's the goal, right? Well, what we're about to see is that blindly trusting that number, just looking at the cash, can be one of the most misleading and dangerous things a leader can do. So let's just start with this bombshell of a question. Is it possible for a company to be absolutely swimming in cash? We're talking millions in the bank, and yet, at the same time, be on a collision course with bankruptcy? The answer, maybe surprisingly, is a 100% unequivocal yes. And understanding the why behind that yes is pretty much the entire point of our discussion today. Okay, let's make this real. Think of a company like a gym or a software service or even a magazine that sells annual subscriptions. Imagine it's January, they run a big sale, and thousands of customers pay for the entire year up front. Ka-ching! The bank account suddenly looks incredible. But here's the problem. You've got their cash, but you haven't actually done anything for them yet. You owe them 11 more months of service. In proper accounting language, that cash you just received isn't revenue yet. It's a liability called unearned revenue. Think of it as a debt. You owe your customers a service, and fulfilling that obligation over the next year is going to cost you money. You have to pay salaries, keep the lights on, run the servers. Those are real costs that are coming down the pike. So this whole situation brings us to two totally different ways of looking at a company's financial health. Think of them as two different sets of glasses. One pair shows you a distorted funhouse mirror version of the truth, while the other gives you a crystal clear picture. As someone who's going to be making decisions, you absolutely have to know which pair of glasses to put on. Now, this definition, it sounds a little dry, but every single word here is critical. This comes from something called GAAP, Generally Accepted Accounting Principles. You can think of GAAP as the official rulebook for financial reporting here in the US. It exists so that when you look at one company's financial statements, you can compare them fairly to another's. It ensures everyone is playing by the same rules. The principle at work here is the revenue recognition principle, and the key words are earned and incurred. You only count revenue when you've actually delivered the service or product, when you've earned it. And you count an expense when you've used up a resource, when you've incurred the cost. It's about the timing of the economic activity, not when cash happens to move around. So let's just put these two side by side. Accrual accounting, on the left, gives you the true story. It's like watching a high-definition movie of the company's performance over a month or a quarter. The cash basis, on the right, well, it's just a snapshot of the bank account. It's simple, sure, but it tells you almost nothing about how profitable the business actually is. It completely ignores those future obligations we just talked about. For any serious business that wants to grow and thrive, the accrual view isn't just an option, it's the only way to see reality. All right, Section 3. So if accrual accounting tells us when to recognize our revenue, we still have another piece of the puzzle, the expenses. This is where the matching principle comes in, and honestly, it's one of the most logical and, dare I say, elegant ideas in all of business. It's the why that makes it all click. Here's the core idea, and it's just pure common sense. If you want to figure out how profitable you were in, say, the month of April, it's not enough to just look at the revenue you earned in April. You have to ask, okay, what did it cost us to generate that specific April revenue? You have to line them up side by side in the same time period. You match the effect, the revenue, with its cost, the expenses. That's the only way to get a true picture of your profitability for that month. We can really just boil this down to a simple three-step process. First, you figure out exactly how much revenue you earned in the period. Not the cash you collected, but the value you actually delivered. Step 2, you hunt down all the costs you incurred specifically to generate that revenue. This could be salaries, materials, marketing costs, you name it. And finally, step 3, you put them together on the same income statement for that period. When you do that, you get a beautiful, clear picture of your actual operating profit. Let me give you a really simple analogy. Say you own a bakery. In January, you buy a $100 bag of flour. Now, under the cash method, you might be tempted to say you had a $100 expense in January, but that's wrong. You haven't used all the flour yet. That flour is an asset. It's your inventory. The matching principle says when you use a little bit of that flour to bake a cake and you sell one slice, you should match the revenue from that one slice with the cost of the flour that went into just that one slice. It perfectly connects the dots between what you spent and what you earned. Okay, that's enough theory for a bit. This is where it gets really interesting. We're now going to see how looking at the world through these two different lenses, cash versus accrual, can lead two managers at the same company to make completely different and potentially company-defining decisions. Let's create a little case study around a company we'll call SaaSco. SaaSco stands for Software as a Service. It's a very common business model today. Think of companies like Salesforce or Adobe. They build software and customers pay a recurring fee, often annually, to use it. This should sound pretty familiar because it's the exact business type we talked about at the very beginning. It's the perfect storm for this cash versus accrual confusion. So imagine it's January. The sales team at SaaSco absolutely crushes it. They bring in $1.2 million in new annual contracts, and they collect all that cash right up front. The money's in the bank. Imagine you're the CEO. You log into your bank portal and you see that number. The office is electric, people are celebrating, it feels like you've won the lottery. So now for the big test. Based on everything we've just discussed, you were the CFO. You have to prepare the income statement for January. You see that $1.2 million sitting in the bank. What number do you record for January's revenue? Take a second and really think about that. And here it is. This slide shows the two paths, the two realities. On the left, you've got the manager with the cash view. They see $1.2 million and their brand just lights up. They think, we are killing it. We're massively profitable. Let's hit the gas. Greenlight that expansion project. Let's go hire those 10 new engineers we wanted. It's a decision based on the emotion of seeing a big number in the bank. Now look at the manager on the right, the one with the accrual view. They see the same $1.2 million, but they know that's an obligation for the next 12 months. So the revenue they've actually earned in January is only 1/12 of that, or $100,000. Their decision is completely different. They'll say, this is fantastic news for our cash flow, and it shows our product has strong demand, but we need to pace our spending. Our decisions about hiring and expansion have to be based on the $100,000 we're earning each month. One of these paths leads to sustainable, smart growth. The other leads straight off a cliff. And these aren't just hypotheticals. These are the classic traps that sink so many promising young companies. They hire those 10 engineers, and suddenly their monthly payroll costs explode. But their earned revenue is still just that $100,000. They pay out big bonuses based on cash they haven't really earned yet. And then, come September or October, they look at the bank account and realize, uh-oh, we've spent all the cash we needed to pay our bills for the rest of the year. And that is exactly how a company that was drowning in cash in January can be filing for bankruptcy before Halloween. All right, let's bring this all together in our last section here. I really want you to understand that this isn't just some boring topic you have to learn for an accounting final. Mastering this concept is a legitimate superpower in the business world. I honestly don't care what your major is. If you're in marketing, you need to understand this to measure the true return on a campaign, matching the cost of the ads to the revenue those customers generate over time. If you're in operations, you have to build your budgets based on earned revenue, not just the cash you have on hand. In any meeting, at any company, being the person who can see past the flashy cash number and understand the real underlying story of the business's performance, well, that makes you invaluable. That's what separates a manager from a true leader. So I'm going to leave you with this final thought. Think of it this way. A company's cash flow is like a person's pulse. It's important, for sure. It tells you if they're alive right now. But accrual accounting, that tells you the story of their overall health. It's their diet, their exercise habits, their lifestyle. It doesn't just tell you if they're alive today, it tells you where they're headed tomorrow. So the next time you look at a business, don't just check its pulse. Ask about its story.